Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me is Frederick, Managing Director of Trading and Derivatives at the Schwab Center, to discuss Nasdaq-100 performance. And Randy, it's really interesting to see the turnaround of fortune that all the major averages have had in the past week. I mean, the Nasdaq-100 up nearly 2% into the close here.
Yeah, it is pretty remarkable. I mean, we were in a pretty ugly downturn for quite a while. And yeah, just since the 14th of the month, which was a little over a week ago, the NDX is up 12%. So it is pretty remarkable. And I think one of the things that has caused that to happen is that people are finally getting sort of tired, or what I often call panic exhaustion, from the situation in Russia, Ukraine. Clearly, it hasn't been resolved, but historically, we know that when geopolitical flare-ups occur, it causes some volatility. Initially, people get a little panicked, but eventually they kind of just get used to it, and it's now the new norm, at least for a while, and then people go back into, what they're normally into. Tech stocks, which is obviously a big weighting in this index, they tend to be high beta stocks, so they lead on the way down. They have a tendency to lead on the way up, and that's why they're doing even better than the broader market.
Right, and Freddie, it's so interesting too, because after we had Jay Powell come out and say that 50 basis points might be more appropriate than 25 basis points, we saw the initial reaction with stocks, but they really trended in a way and absorbed it. Even with the geopolitics, to your point before, in stride, and I think we spoke about this a couple of weeks ago. Perhaps when we take a look at this on a longer term chart, let's say 5 to 10 years from now, will this potentially be a blip as we saw with COVID?
Yeah, potentially. And the thing about higher rates is that this is the first time in a very, very long time that the Fed has gotten into a tightening cycle when it actually had something like high inflation to combat. All of the previous hiking cycles, some of which caused the market to kind of go off track, were done sort of preemptively in anticipation of potentially higher inflation, which ultimately never occurred. This time, while the Fed's gotten beat up quite a bit for being apparently behind the eight ball, or behind the curve, or whatever term people would like to use, I think that's an okay thing, because this time at least they waited to be sure that we truly did have inflation, and now they're tackling it heavily. Fascinating thing about what you said, when Jay Powell spoke the other day, he almost explicitly said we're going to get a 50 basis point hike on May the 5th, May the 4th, I think it is, which made the probability from the futures markets perspective jump from 48% to about a 75% probability that that'll happen. So I think, frankly, it's very likely. But what the markets are telling us, and what they're telling me, is that they're a lot more worried about inflation than they are about higher rates.
Right. And prior to the geopolitical headlines really hitting the tape in mid-February there, it seemed as if the market was digesting what was on the table with the Fed. Yeah. And we understood inflation needed to be tampered. And we had this expectation of 6 to 8 rate hikes for the year. And I wonder if we would have seen the dramatic volatility that we saw in the absence of these headlines, because it seemed as if the market was kind of getting back on track outside of that.
Yeah, I mean, volatility had been elevated since about the second day of the year. As you remember, the last time, the market hit a record high, or pretty close to it, was right at the beginning of the year. And volatility had been somewhat elevated, but clearly the spikes that we've seen in volatility over the last 2 to 3 weeks have been related to the issue in Russia and Ukraine. So yes, it was elevated, but not to the extent that we saw. And I think, in fact, the downturn that we saw, I mean, the NDX did dip into bear market territory very briefly for about a day and a half. I don't think we probably would have seen quite that substantial of a downturn had it not been for that issue. But again, ultimately, history tells us that these things tend to be relatively short-lived. And there's obviously things that can change. Of course, if we get into a more of a ground war, if Russia attacks a NATO country like Poland, which is possible, if the U.S. has to send troops, all of those things can change that dynamic. But given the current situation and what we know there are some negotiations going on. Frankly, if we get a resolution of some sort of peace agreement or whatever, I think the markets could take off pretty solidly at that point.
All right, Randy, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
You're quite welcome.